Welcome to Griffonomics.
Thank you. It's great to be here for this one.
Yeah, and whether you are prepping for a high-stakes meeting right now or you're just insanely curious about the psychology of success, today's deep dive is tailored specifically for you.
Absolutely. We've got a really fascinating topic lined up.
We do. We're getting into Mark Douglas's concepts from Trading in the Zone. Specifically, we're focusing on what he calls the mental analysis inflection. But I want to pose a provocative question to you right out of the gate.
All right, lay it on me.
Why is it that brilliant analysts, right, like Ivy League lawyers, doctors, successful professionals, why do they often fail miserably at trading while a casino makes billions of dollars a year on purely random events?
Right. That's the ultimate paradox. And our mission today is to give you a really granular strategic report, an actionable roadmap, really. We're going to explore how to bridge that gap between knowing exactly what you should do and actually executing it flawlessly when the pressure hits.
Yeah, because to understand why smart people fail, we first have to look at how our approach to market data has evolved over time, and more importantly, where it falls short.
Exactly. I mean, if you go back, the initial approach was all fundamental analysis.
Right, the pure math.
Yeah, purely mathematical models. People thought they could project future prices perfectly by just crunching numbers. But then there was this evolutionary shift to technical analysis.
Because they realized math wasn't enough, right? They had to look at behavioral patterns.
Spot on. But even then, tracking behavior on a chart still leaves a massive hole. And that brings us to the final evolution, which is mental analysis. It's the realization that consistent performance is a byproduct of your internal mental architecture, not just gathering more external data.
Because those mathematical models, they create what the source calls a reality gap.
Right. The math assumes everyone is acting rationally, but it completely fails to account for the highly emotional, irrational participant who just happens to have enough capital to move the market.
Oh man, there's that great anecdote from the book about this.
The soybean story.
Yes. So there's this top-tier technical analyst, and he's sitting with the chairman of a major brokerage firm, right?
A guy who used to trade in the pits so he knows how it actually works.
Exactly. And the analyst is pointing at this soybean chart, swearing up and down that based on his precise mathematical calculations, the market has hit absolute support. It literally must reverse right there.
And the chairman just looks at him, picks up the phone to the trading pit, and casually says, sell 2 million bushels of soybeans at the market.
Just to prove a point.
Right, and within 30 seconds, the price drops 10 cents a bushel. The chairman looks at this completely horrified analyst and says, now, where did you say the market was going to stop? Because if I can do that, anyone can.
Okay, let's unpack this, because that completely destroys the illusion of the perfect model, right? It introduces the psychological gap.
It really does.
It's like a golfer who knows the exact physics of the perfect swing. They've studied the biomechanics for years.
But they freeze up and shank the ball the moment they step onto the 18th green at a major tournament.
Yes. So I have to ask you, is consistent performance really just a byproduct of internal mental architecture rather than just gathering more external data?
I mean, yes, but it's deeper than that. If it's all about internal architecture, we have to ask why our brains freeze up in the first place. And it's because the market environment presents a profound structural paradox.
What do you mean by that?
Well, the market environment directly contradicts how society has trained us to behave since we were kids. Think about it. Society trains us with external rules. Stop signs, deadlines, bosses telling you what to do.
Right, there are boundaries everywhere.
But the market offers limitless freedom of expression. There are zero external rules telling you when to start or stop. And to a human brain, a boundaryless environment is inherently dangerous.
Because we don't know how to act without guardrails.
Exactly. And that leads to the passive loser risk.
Oh, yeah, this concept blew my mind. Because unlike a casino game, say blackjack.
Right, blackjack has a formal beginning, middle, and end.
Exactly. To lose more money, you have to actively push chips into the circle. But a trade has no formal ending.
None. You can just sit there and watch your entire account vanish. Simply by failing to act, you become a passive loser.
Man, that is terrifying. And the source outlines 4 primary dangers in this environment. The first one is an unwillingness to create rules.
Because we subconsciously rebel against rules. When we finally get total freedom, we don't want to restrict ourselves.
Right. And the second is a failure to take absolute responsibility.
Which is easy to do, right? You just blame the market. You say, oh, the algorithm screwed me, or the news was rigged.
Yeah, anything to avoid blaming yourself. The third danger is the addiction to random rewards, like a monkey pressing a lever for a random treat.
And that is purely neurochemical.
Mhm.
Random rewards trigger massive dopamine spikes. It's incredibly addictive and destroys any chance of logical consistency.
And the fourth danger, which I think is the most insidious, is the illusion of external control.
What's fascinating here is that this specific illusion is exactly why successful professionals actually fail.
Wait, really? Because they're too successful in the real world.
Yes, because in society, they've learned to manipulate and control their environment. A lawyer persuades a jury. A CEO commands a boardroom. They use control techniques to get what they want.
Ah, I see. But the market doesn't care.
The neutral market absolutely does not respond to your manipulation. You can't argue with a stock chart. So the very tools that made them brilliant in real life cause them to fail in a boundaryless environment.
Because that lack of boundaries forces us to confront our fears. And when we get scared, our brains start playing forensic tricks on our perception of reality.
It's all about the association mechanism. The brain projects internal pain onto neutral data.
Let's deconstruct the child and the dog model from the book because that makes it so clear.
Yeah, so imagine a child who has never seen a dog before. They walk up to one and the dog bites them.
Horrible pain, totally traumatizing.
Right. So the child's brain instantly associates that physical and emotional pain with all dogs.
So even if the next dog they see is a super friendly, tail-wagging golden retriever,
The child feels absolute terror.
yeah.
The dog is friendly. The present moment data is totally neutral and safe. But the brain is projecting the past pain onto the current reality.
And traders do this exact same thing. They take a bad loss, and a week later, they see a brand new, completely valid setup on a chart.
But it looks a little bit like the chart from last week. So their brain projects the pain of the past failure onto this new, totally unique moment.
Here's where it gets really interesting, because the brain doesn't just make you feel afraid. It actually deploys information-blocking behaviors.
Yeah, the subconscious goes into overdrive to execute pain avoidance. It starts rationalizing and justifying.
Oh, the volume is a little low, I should wait.
Exactly. Or worse, if you're in a losing trade, your brain will literally delete opposing data from your awareness. You'll only focus on the tiny upticks while the overarching trend is actively crashing.
Wait, so you're saying our brains are biologically wired to make us go blind to the reality of the market just to spare our feelings?
That is exactly what I'm saying. Your brain prioritizes emotional protection over financial survival. It acts like a filter, just deleting the reality you don't want to see.
That is insane. So if our brains are actively working against us, how do we fix this perceptual blindness?
You have to adopt the mindset of the house. You literally have to think like a casino.
Okay, the casino paradigm.
Right. Think about a casino. They don't care about the outcome of one single hand of blackjack.
Because they have a probabilistic mindset.
Exactly. They rely on macro certainty in their overall results versus micro uncertainty in individual events. Over 10,000 hands, they know they'll make a profit.
Because they have an edge. So how do we get that mindset?
Douglas outlines 5 fundamental truths that have to be hardwired into your belief system. The first one is simple. Anything can happen.
Because it takes just one irrational trader with enough money to negate your perfectly calculated edge.
Right. Truth number 2. You don't need to know what happens next to make money.
Which is so hard for professionals to accept because their whole lives are based on knowing what happens next.
True, but it ties into truth 3. Wins and losses are randomly distributed. You can't predict the sequence.
So even if you win 60% of the time, you might have 4 losses in a row first.
Exactly. Truth 4. An edge is nothing more than a higher probability of one thing happening over another. It's not a guarantee.
It's just a slight tilt in the odds.
And truth 5. Every moment in the market is totally unique, which means projecting past pain onto the present is entirely illogical.
So what does this all mean? Like for the listener trying to actually use this, to me it points to just this immense psychological relief.
How so?
Well, if you truly accept that you can't know the future, you completely neutralize the emotional pain of being wrong.
Right.
You can't be wrong if you never expected to know the exact outcome of that specific trade in the first place.
That's a great way to put it. You're just pulling a lever where you have a slight mathematical advantage.
But knowing those 5 truths intellectually is entirely different from actually believing them when your money is on the line.
Oh, completely. Which is why we have to talk about operationalizing consistency. We have to actively rewire the brain's internal energy.
And the source introduces this concept of beliefs as structured energy, right?
Yes, energy cannot be destroyed. So if you have a self-sabotaging belief,
Yeah.
like the desperate need to be right all the time, you can't just delete it.
You have to deactivate it.
Exactly. You draw its energy out and transfer that energy to a new, useful concept.
And those new concepts are the 7 principles of consistency. It's basically a checklist.
Right. Principle 1, identify edges objectively.
Okay.
2, predefine your risk before you ever enter.
3, accept that risk completely so you don't panic.
4, act without reservation. 5, pay yourself as the market makes money available.
6 is to continually monitor your errors.
Right.
And 7, never violate these principles.
Because when you do, that's when self-sabotage kicks in. It manifests as this invisible barrier, like a glass ceiling in your equity curve.
Yeah, when people build up their account, hit a certain number, and then blow it all up because of deep-seated self-valuation issues, they don't think they deserve it.
If we connect this to the bigger picture, this fundamentally shifts your entire goal. You aren't trying to beat the market anymore.
Right.
Your only goal is mastering your own mental energy. The market is just a mirror reflecting your discipline back at you.
Okay, but how do we practically transfer that energy? How do we enforce those 7 principles so they aren't just like a nice theory? We need a real action plan.
And that brings us to the mechanical stage, specifically the 20-trade exercise.
I love this part. Okay, I'm going to break down the rules for you, the listener, because it is delightfully brutal.
It really is.
You commit to exactly 20 trades, and you execute them with rigid robotic discipline, 0 subjective interpretation.
None. If your edge says go, you go.
You have predefined stops, and you use mechanical profit scaling, like automatically scaling out of the position in thirds as it goes up. You don't tweak it. You don't think about it.
And what's the goal here? The goal isn't necessarily to make a ton of money on those 20 trades. The goal is to force a structured head-on collision with your fear-based beliefs.
Yeah, you're forcing your brain to see that the world doesn't end when you take a loss.
By executing a rigid system flawlessly, your mind is basically forced to accept the probabilistic nature of the market. And as you do that, you inadvertently drain the energy out from those self-sabotaging beliefs.
And you build ultimate self-trust because you know you will follow your own rules.
But this raises an important question.
Uh-oh.
I'm asking you, the listener, directly. Do you have the discipline to execute 20 trades without tweaking the rules just once? Without intervening because you suddenly felt like you knew what the market was going to do?
Most people don't. They'll get to trade number 4, get scared, and pull their stop loss.
Exactly. But if you can survive that mechanical stage and finish those 20 trades, where does that leave you?
It brings you to the ultimate destination of this deep dive, the zone.
The zone. It's a state of synchronicity.
It sounds kind of mystical, but it's really not, right?
No, it's highly clinical. It is simply the perfect resolution of labor between your rational brain, which identifies the mathematical edge, and your creative brain, which handles flawless execution without hesitation.
And to stay in the zone, you rely on 2 professional pillars. The first is objectivity.
Right, which means having unfiltered access to your knowledge, because all those pain avoidance mechanisms we talked about, they're turned off. Nothing is blocking the data anymore.
And the second pillar is making yourself available. You approach the environment with absolutely no agenda to prove yourself. You don't need to be a hero.
Achieving this state makes trading, or frankly, any high-stakes decision-making, feel entirely effortless.
It's like a superpower. But we should ground this a bit, because it takes extreme mental discipline to reach that carefree, effortless state, right?
Oh, absolutely. It's not a permanent vacation.
Yeah.
You have to actively maintain that mental architecture every single day.
Yeah, so let's wrap this up. Remember, consistency isn't found in the market. It's not in buying a better algorithm or endlessly gathering more data. It is found entirely within your own mental architecture.
I want to leave you with a final thought to mull over.
Go for it.
We've just spent this entire time talking about how our brains are literally hardwired to protect us from emotional pain by distorting reality. They make us blind to obvious trends just to protect our egos.
Yeah.
So if your brain does that while looking at a chart, in what other areas of your personal or professional life are your subconscious pain avoidance mechanisms currently tuning you into a passive loser without you even realizing it?
Oh, man, that is heavy. And so true. Risk defined, edge executed.